Good afternoon and welcome to Pincus Co Live. Today we're speaking with broker David Schechtman of Meridian Capital Group to discuss strategies brokers and investors might use if the market heads into a steep decline. David leads the middle market team of Meridian Investment Sales as a senior executive managing director, overseeing a group of originators, analysts, and other professionals. He has personally sold more than 790 deals, representing more than $8 billion in his career to date. I'm Adam Pincus, founder of the 3-year-old news and data company Pincus Co Media. This episode is sponsored by Gparency, a provider of technology solutions designed to empower commercial property owners and reduce their reliance on certain high-cost service providers. This is episode 16 in our weekly series of live broadcasts. Prior episodes are on our YouTube channel. And David, welcome back to the show. Reading your bio and then doing the math, it looks like you started a little bit before Lehman Brothers crash, but can you talk a little bit about how you got into real estate in the first place?
Sure. First off, always a pleasure to be here, and greetings to everybody, and happy Tuesday. So there I am as a sixth-year lawyer at DLA Piper, pretty full of myself, probably more full of myself then than I am today, doing due diligence in Hope Hull, Alabama, about 2 o'clock in the morning, well-paid gig as a sixth-year lawyer in 2005. And going through documents, I see that in a bankruptcy transaction, a real estate broker, 27 years old, and I was older than that at this point, was making an exponent of what I made in an entire year on one transaction. I simply quit a few weeks later, had some mutual friends at the now defunct Eastern Consolidated, became a broker, spent 10 years there. And August 17th, in 2015, got a call from Ralph Hertzka. We do $60 billion a year in mortgages at Meridian. We always were salespeople as well, but we formalized our sales group. We now have 32 people, and God willing, we'll do $3 to $4 billion in sales this year.
That's the love of real estate.
Exactly. Well, Adam, I don't want to suggest that it was the pursuit of money. It was something I was always interested in. I was a bankruptcy real estate litigator, but I think I'd be lying to your viewers, and I think a lot of viewers would be lying to themselves if they didn't say part of the reason they're interested in real estate is not to save humanity, but to make the big bucks. And anybody who says they aren't is likely not telling the truth.
Well, so that's part of the reason we wanted to talk today, because you and I were discussing the Lehman collapse and sort of what happened after that. And now there might be something coming down the pike. So I wanted to ask you first, why do you think that there might be a downturn?
Well, Adam, the suggestion that there might be a downturn is kind of like standing in the middle of New York City at 2 a.m. with a sign that says, "Come rob me." I think it's inevitable at this point, and I think popular wisdom, I don't think there's any viewers who need convincing that we are in a heavily downward spiral at the moment. I think it's a confluence of events. Really, this started, first off, as you know, real estate cycles are 7 years, generally, peak to peak and trough to trough. By 2018, we had an incredible run up. By 2019, New York City started engaging in some draconian legislation, which really stymied values in multifamily and other assets, and it was the beginning of a natural decline. And then, obviously, the Wuhan virus in 2020 and the government's mishandling of it and shutting down commerce really gave real estate a beating. And now with what is civil unrest coupled with a credit crunch, all of which I believe are undeniable facts. I'm not saying what's right and what's wrong. This isn't a political show, but we are certainly in very troubling waters. I think that opportunity abounds. You know, we have to, while we know about the John Paulsons of the world and the people who make the counterintuitive bets in a down cycle, you really never hear about the people who decide to make big bets and fail, because those stories aren't as exciting, candidly. I'm with Paulson on this one. I think it's time to come back to New York City, not just because I'm a real estate broker. The truth of the matter is, I don't care if I'm selling in an up market or down market. What I care about is generating fees. I'm not saving lives and I'm not selling private homes. So these are all accredited investors with whom I deal. I think that we're coming into one of the most opportunistic times, certainly in my 47 years.
So I was looking back at some of the sales that happened in 9 and 10. A lot of the headline grabbing ones, a lot of them actually had to do with Harry Macklow, and not just him, but there was other. I mean, he had an extraordinary purchase that fell apart earlier, but a lot of it was like big purchases that just didn't go very well. Is that, I don't see that happening right now. Is like, do you think there'll be the same kind of like big fall?
So my world, I can speak to where I have significant market share, which is the 20 to about 150, $200 million range. I leave the $500 million to $1 billion buildings to the Helen Wongs and the Adam Spies of the world. But I will tell you, as a former bankruptcy lawyer who's still admitted to the bar and frequently appears both in bankruptcies and other court proceedings, and somebody who provides services to portfolio lenders, non-conventional lenders, funds, credit funds, in good times and in bad, I could tell you that this is going to be up and down the food chain and up and down the capital stack. What do we mean by that? Everybody will tell you, anybody who's been doing this more than a couple of years will say, multifamily deals that were purchased in the past 3 to 5 years are likely going to have some rocky times because the refinancing market is not as fervent and the rates have gone up 10 to 30%. We all know that there are some troubling times in the multifamily world. We all know that retail has changed and started changing in 2015 when technology evolved. There's a reset. I just sold a retail condominium, a fee simple retail condominium for $8.5 million in Green Street. We had an unsolicited offer on that deal 48 months ago for $30 million. Rents went from 500 a foot to 115 a foot. But what I want to posit here today is I would say you're going to see distress across the board, including with industrial. Mm-hmm. Industrial has been it's interesting because it mirrors the meteoric rise from 2010 through 2015 that retail enjoyed nationally. Everybody was going to turn their junky warehouse into a nicer warehouse, and Amazon was going to lease it, and Prologis was going to buy it. Well, a couple months ago, Amazon said, hey, we're long on real estate. We're kind of saturated. And what's happened is for every warehouse, and obviously there's exceptions to this, a lot of people bought these warehouses and logistics and distribution centers and cross docks. A lot of people bought these things with the expectation simply, it's the Kevin Costner syndrome. If you build it, they will come. If I buy it, the market will ascend. Well, unfortunately, a lot of people, including in the New York area, paid outsized numbers, and let's just call them warehouses, mm-hmm. because there's a lot of misnomers in that field. But let's just say they bought big warehouses expecting rents to go from 10 a foot to 30 a foot. There's not as much tenancy as people had originally believed. Don't get me wrong. I am still selling fee simple warehouses a mile a minute. I still think it's the preferred asset class, but I think that there's people making some super risky bets that I wouldn't go behind.
Let me, before we go into, I don't want to dive too deep into the asset classes. I want to look at how, if with the posit, the theory here is that things are going to get bad. How should somebody first plan right now, and then what are they going to do? I mean, there's obviously note buying and all that kind of stuff, but what are the ways in that you saw in 2009 and 10?
Sure. I certainly don't want to give up the ghost and give you the Rolodex. Although after 17 years in the business, what I've learned is the number one thing, obviously, in real estate, you don't need some guy in a polo shirt calling from his house to tell you that relationships are paramount. And there are a lot of neophytes there who think that they're going to cold call bankers and they're going to make quick cold calls and be handed these, what we would say at Meridian, Mitzias, these bargains. Wow, I'm going to buy it at 6, and in 8 years, it's going to be worth 40. Those things are going to happen, but many of them are going to be spoken for in advance. In 2008, we called that phenomenon the credit crunch. And one of your former employers, where you were one of the most senior folks, actually did me the favor of identifying winners and losers. And they said, post-credit crunch, who are the winners and losers? And they actually had me on the same page as Mort Zuckerman, which was just laughable to my wife and to me. I was a real estate broker and still am. But what they talked about is who's positioned to benefit from this. And I think that whether you're an owner, and I know that there are scores of owners who watch and listen and rely on your feeds, and there's certainly a lot of brokers, lawyers, etc. I think that that work needed to have been laid yesterday. Whether you're
just go meet the people or go.
It's beyond meeting the people. Look, there's still an opportunity. There is a 27-year-old, figuratively, there's a 27-year-old real estate broker out there, and she or he is going to make enough cold calls that they are going to find an opportunity that once was worth 50 that may trade for 30 today, whatever that opportunity may be. Whether it's a fee simple deal, whether it was a leasehold, whether it's a note purchase, they're going to sell it or invest in it. And the tide will rise again, whether it's 3, 4, 5, or 7 years. People will make fortunes because of this downturn. The question, how do you do it?
How do you, how do you get in? I mean,
number one rule. So we already talked about relationships.
Right.
There is a special servicer nationally who, for the past, call it, I would say we would all agree the last real downturn, we had a hiccup in 2019, was 2008 through 2010. I think we could all agree that was the last catastrophe. Since 2010, I've been providing at least 5 to 10 times a year some form of service to this national special servicer.
Like BOV stuff, or like
broker opinions of value, valuations. I've been available to provide data. One of my colleagues in the industry, who is a dear friend, a competitor, and somebody who I look up to, is you have to give before you can get. And James Nelson, I don't mind invoking his name, he's a powerhouse in the industry. James Nelson is a guy who, in good times or in bad, transfers data and has something important to say. We at Meridian, and I don't want to sound like a commercial, we have so much proprietary data that I will get a call on a random Thursday from the best and the brightest in the city, and the conversation will go like this: Schechtman, I'm not hiring you for this. The deal is almost done. I have some data gaps. What can you tell me about this? Can you get me comparable data on that?
These are why no one, like, what are ways for people to get in? So it's basically to use, like,
so Adam Pincus
decides, they need.
So, okay, so you want the blueprint for Adam Pincus decides to give up decades in the media and decides, I want to get rich doing distressed real estate. Is that the question, Adam? Because if it is,
sure.
Because if it is, we're going to have to get you out to every event in every corner of this city, even if you roll your eyes and you're bored out of your mind. You need to get out there and meet people. But the number one thing you need to do, other than relationships, because I've said that 8 times, is you need to do research. One of the greatest things about my partner of 10 years is when we all finally go home late in the evening and he's put his young kids to bed, we are tickling the ivories. We pull up deals that are ripe for either a refinancing or some other capital event. We keep a log of everything that's been sold for the past 5 or 10 years. We study deals as we're driving around the city or walk. Well, I don't walk around the city anymore because it's a war zone, but as I'm being driven around the city, I'm not going to lie to you. And I'm not going to lie.
I'm not going to lie either. It's not a war zone, but
okay. Well, we'll leave politics for next week's
right,
time.
well,
Best of luck underground. That seems like a safe bet. So as I'm being driven around the city and I look at vacancies, whatever happened to this? Oh, XYZ Broome Street. It's 50 feet wide. Both stores are vacant. I don't know who the owner is. I'm going to give him a call. Wonder if he'd rather sell. Oh, the owner says he doesn't want to sell. His mortgage is coming due. I wonder who holds his mortgage. These are the things you have to do. Just making a cold call to a bank probably won't get you past the 1-800 number. But calling up a lender and saying specifically, or sending an email saying, here's who I am and here's what I know. Here's who my client is and here's how legitimate they are. I know for a fact that your loan matures in August. I also know for a fact that Armani is leaving the building in August, and they are 90% of your income. I think you're headed off a cliff. How can I provide my services? So in December, I sold a defaulted note for $146 million on Fifth Avenue in Manhattan with no fanfare, no Pincus Co., no traded, and whatever other publications may exist. I don't look beyond Pincus Co. It never made the press. It was 96 cents on the dollar. Those opportunities, I had been tracking that opportunity since the loan was originated 9 years earlier. It's research, it's data. And as cheesy as it sounds, but I feel like every time I speak, I've already jumped off the diving board, so there's no turning back. It's no different from the line in Wall Street, where Michael Douglas turns and says, you want the answer? You want to provide value? Information. You want to provide value? Data. Go and do research. Find a car that's heading off a cliff and prevent it by providing value. Don't just call up the junkyard and say, can I see all of your wounded cars? You ain't getting anywhere because you'll be one of 10,000 people doing it.
So that is a conceptual, very valuable concept of how you should kind of get in front of somebody and provide them a reason to call you back. What are some of the strategies in a literal sense? So there's note buying, and sort of calling, driving around, looking for stuff.
Sure. I think there's plugging holes. And when we talk about landlords in the city, so often people think of the storied landlords, the Rudins, the Lloyd Goldmans, the Relateds of the world, the Himmel Mehringdorfs. These are not groups that need your money. These are groups that even if they had a building that financially was upside down, they could stick their hand in the couch, cushions, and they can repair it with their own equity. That is nobody is too big to fail. Nobody's impervious to an iceberg. Some of the aforementioned certainly are. Sorry. So how do I find an opportunity? You find buildings where you cannot for the life of you imagine they're doing well financially. Come to that building owner with a pocket of rescue capital. First, go out there and come armed with money. Never call somebody up and say, hi, I know that you're drowning at the moment. I'd like you to designate me to save you. They just want a life raft. They don't care who you are. They don't care if you went to Penn or CUNY. They don't care if you're Syrian or from Texas. They want the life raft. So it's, hi, can I speak to Mrs. Smith? at XYZ Corp. Look, I've been tracking your building. I'm not selling it. I know you're not selling it. And I have an idea. I've been dealing with a group out of Chicago that's dying to own buildings in New York. They only need an 8 or 9% return. I wish I can get 8% of my buildings in New York. Well, I know that you've lost some tenants, and let's not BS each other. This group wants to bring you fresh capital. They want to retire your debt. They want to help you to pay it down, your debt. They want to help to improve the building, and they want to be a passive partner. I don't need partner. You know what? For the first time ever, I may need a partner. There is a third generation family with whom I deal that in 2011 and 12 boasted to me that in the 80 plus years that they've owned their several hundred multifamily buildings, other than family members, they never took on a partner. This family in 2014, after an introduction one of my partners made to them, divested themselves of about 20% of their portfolio with a fresh, non-controlling, with a fresh capital infusion in order to help them to continue to execute the way they needed to execute. If you think about it, and I'm going to let you speak in a moment, Adam, if you think about it, the greatest football player on earth sometimes needs to sit down and drink some Gatorade before we put him back out there to do what he's supposed to do. Be the Gatorade. Be the refresher, the replenisher. Don't just call up and find if the cadaver is dead and then sell the cadaver. Add value.
When you're talking to the people in Chicago, or the people who are offering to give money, are they specifying the kind of asset? Like, do you talk ahead and say, hey, I got my eye on a guy?
100%, 100%. So again, not to sound like a commercial, last week I got a phone call from, I'm on the 25th floor of Meridian, 26 is where the mortgage wizards sit. I got a call from a fella in the office who I really don't deal with often, who said, I have a group. The reason I say Chicago, he said, I happen to have a group in from Chicago. They want to deploy about 100 million of capital in New York. My knee-jerk reaction is to roll my eyes, because for so many years when the market's good, who needs money from Chicago? I've got money from really exotic places like Great Neck or Deal, New Jersey. I don't need money from Chicago. When times get tough and the barrier to entry is lower in New York, or the perceived barrier to entry is lower because there's distress, these folks are going to capitalize on it. I sat down with them for an hour. And as a broker, my job, which is excruciating for me and for anybody who's listening who knows me, is to shut my mouth and take notes. I have to go shopping for this group. That's my job. And what they're seeking is going to be on the shelves. Sometimes I have meetings with capital from Spain or someplace else, and they say, David, we have $100 million. We want cash on cash returns of 14%. And we want no rent regulation, and we want to be on an avenue. And I say, phenomenal. I want to introduce you to somebody in Columbus, Ohio. I think what's going to happen now is you're going to see the barrier to entry lower slightly, cap rates expand slightly, go to the new entrants. Any of us can call up, I don't know, we all know Richard Wagman has $5 billion. We know what he wants to buy. He's a super creative guy. Find the next Richard Wagman. Find somebody who may make a bet a little riskier than Richard. Sorry, Richard, you're only one of the finest operators in the country.
So is that through looking at people who are buying stuff, or someone who just bought one property? So after someone buys something, they get 100 phone calls, and people are trying to figure out whether they're going to make these kinds of bets?
Adam, I think I would start off with, cash is king. In a down market, dry powder is king. If you're at a flea market and all of a sudden somebody screams 20% off cash only, you're going to rock and roll. I think capital, years ago, some cheesy broker said that equity and debt are the like beer at a fraternity party, liquidity. We know that the faucets are closing slightly. That's not to say you can't get a mortgage today, because you most certainly can, and we're cranking them out. But when that faucet tightens a little bit and the bankers are becoming a little bit more stringent, maybe proceeds are slightly less and rates are higher, then the balance of the capital stack is cash and it's equity.
Mhm.
I would marry myself to 5 to 10 amazing buyers. I would also make sure that they have incredible lawyers. So I will get a call from somebody from Chicago who says, yeah, I'm going to put out $100 million. I'm going to do it 10 or $20 million at a time. The first thing that I ask them after I find out, okay, they're pretty realistic, I think I could create these opportunities. Who are you using in New York City? And this is not to cast any aspersions on any lawyers, but if they say, I'm using this firm in Ohio, they have no New York offices. There are some phenomenal lawyers nationwide who do billions of deals in New York. I would much rather hear they're using Leo Leva, Cole Schatz, Michael Lefkowitz, the folks at Herrick, Jonathan Adelsberg, the mechanics. Give me Andy Alpstein, and the list goes on and on, the Iranestovs, the folks who are, the Brian Cohns, the folks who are transacting here daily. That is step 2. Here's what I want to buy. It's pretty real. Here's my lawyer in New York. He's good, but he has sharp elbows. When he calls and says, I'm giving this new buyer the imprimatur, that is the package. Now, you as a broker or a bank or whomever, now you just need to source the opportunity. Speed. Speed matters in New York City. Know what you're saying first, but this is too high level. You want to get a little more granular. So the next question you want to ask me is, can you provide a phone list of numbers for people who are going to sell mortgages? And the answer,
a different question. Well, I was looking over some of the people that bought back then, and Watermark Capital Group, it's, David Tabak, Judah Klein, John Ilavasi, he's been buying some stuff.
Sure.
Zalman Wagshaw is doing, it's got
Isaac Hager, Savanna Partners, Michael Delshaw, who I sold a handful of notes, Ellie Tabak, let's not forget the Azra, and some of these folks don't want to be named. There's a lot of huge operators under the radar.
What are they doing? But one of the questions I have is, like, in 2009, if you, I don't know if you were dealing with any of the sort of smaller multifamily kind of purchases.
I certainly was.
What made them think this was a good time to buy something? Because they've been here for 50 years and they're like, it's going to be fine.
Some of the aforementioned groups have been doing this longer than you and I have been alive. Some of them have grown up with mothers and fathers. By the way, notice I'm being magnanimous and equal, with fathers and grandfathers who've been doing this for eons. A lot of them also just have to deploy money cyclically because they rely on fees and they rely on entrance and exits. But I think the one thing that unifies all of those groups is they all continue to believe in New York. And they said from 2004 through 2007, and then a little bit in 2008, I think the rent just got too damn high, whether it was an office building or a multifamily deal. Bear and Lehman disappeared. I think we had so much inactivity. I personally earned $6,000 in an 11-month period in 2009. By January of 2010, lenders were shedding assets. They also realized that regulators were putting an unprecedented amount of pressure and scrutiny on portfolio lenders to divest themselves of their cancers. The difference, and I always am studying the past so we can improve the future. It's no different than when my son looks at game film from his lacrosse games to improve himself. How can I do better now? One big difference is in 2019, we already were starting to see the decline. The minute Wuhan hit, lenders started on their own volition.
Just to translate, that's crazy talk for COVID, but just,
Okay. Right. It's all crazy until there's
no, here, just continue.
we'll continue until there's a Chinese in our state house.
Just
But let's
continue.
keep moving.
Okay.
You know, what you have to realize is in 2019 and 2020 during the coronavirus, lenders of their own volition started realizing these assets are worth less. And lenders generally mark to market their values on a quarter by quarter basis. So if you think that a lender is having, because they are fiduciaries to their shareholders, they've been sitting in a room, their investment committees and their valuation committees, they've collecting BOVs from me and folks, in my universe. Look how much runway there's been already. In 2009, part of the reason why there wasn't activity is because you would say to a bank, overnight, your $20 million mortgage is worth 14. The bank would say to you, what? I can't take that big of a hit right now. We'll be out of business. Look at Brooklyn Federal Savings. I sold 8 of their mortgages. They're no longer with us. But other lenders said, we need a year or so to mark this stuff down. This time, banks, they're kind of smart people. They've been marking down the value 2020, 21. Now we have a credit crunch. They may have already lowered the values. I think you're going to see a tsunami of opportunity by Q4 of this year and all of next year. I never said during all of the panels and the speeches and the virtual cocktail hours and the little fear parties that we had on our iPads during coronavirus, as you would call it, I never said during those parties, wow, this is going to be a great opportunity in 12 months. I said it's going to take 2 to 3 years to come out. Well, guess what? August of 2008, bear crashed. 2010-11 is when you started seeing opportunity. Coronavirus hit. We faked our ways through it, kind of, sort of. Credit crunch really hit about last year. In 2 years from now, I expect 80% of my business is going to be selling what you would call distress. I think I've got 2 to 3 years of that.
So, well, on that, we're going to rewind the tape in 2 to 3 years and see where we are. We'll probably have you on before then. So, David, thanks.
Always a pleasure.
For those watching, we're going to have this, it'll be on our YouTube channel, probably tomorrow or the next day. And have a great afternoon. Thanks a lot.
Be safe, all.